Start the recording right now. And under financial statement analysis, under chapter 3, we are going to cover the ratio analysis. In the ratio analysis, first we'll see why these ratios are useful, right? First one, the ratios will standardize the numbers of the financial statements in the income statement, cash flow statement, as well as statement of financial position, right? To facilitate the comparisons. So if we have just numbers with millions and billions, it's difficult to compare between companies. Therefore, the ratio analysis will normalize the numbers into a standardized format in a percentage form. Then it's used to highlight the weaknesses and strength. So if a particular ratio is going up, we can see it as a strength. And if it's a particular ratio is going down, we can identify the weaknesses. So in order to identify these weaknesses and strength, rather than comparing the ratios, we have to go for the better analysis of the comparison of chairman's review, then general manager's review, and financial highlights to ascertain the weaknesses and strengths. Then it will enable to measure the relationship. So we know that some particular ratios are creating in between the calculations of the other ratios, such as ROCE. So in the ROCE, we are going to take the net profit margin, then asset turnover, right? As well as leverage ratio. So by multiplying all of them, we are going to create the ROCE. Therefore, this ratio analysis enables to ascertain the measurement of the relationship between certain variables. The next one, it will enable to identify the industry standards. So when we are going to CSC, you can see industry standards or industry averages. So by identifying the industry averages, we can compare the companies and identify the benchmarks. Finally, it will act as a summary of statistics. So even though we have numbers, if we are presenting it in a percentage form, then it will be easy to analyze the summary. Now let's move on the major categories of ratios. First one, liquidity. So in the liquidity analysis, we are going to see, can we make requirement payments? So if we are unable to pay, then there is a liquidity issues. So liquidity is focusing on the short-term financial repayment ability. Then asset management. So these asset management ratios are known as the efficiency ratio. So here we are going to see whether we have the right amount of assets versus to the sales, which means whether these assets are able to generate adequate sales by utilizing them. So as I mentioned earlier, this is known as the efficiency ratios. Why? Because it's measure performance. Then next one is the debt management ratio. So in the debt management ratio, we are going to focusing on the solvency. In the solvency, we are going to see in the long run whether we have the right mix of debt and equity. So here, mainly we are going to use two ratios. First one, right? The total debt management ratio, and the other one is the solvency ratio. That is debt divided by equity. Then the next one is the profitability ratio. So in the profitability ratios, when it comes to profitability, what you can gain most is all the profitability ratios, which gives profit. But here we are focusing on whether the sales revenue and the cost, when we are comparing the sales revenue and cost, we can identify the profit. So whether this profit is enabled to recover the most of the cost in a particular company. So if we are focusing on the trading cost, then we are going to calculate the gross profit ratio. If we are focusing on the non-manufacturing cost, then we are going to focusing on the operating profit ratio. If we are focusing on the overall cost, then we are going to see the net profit ratio. Likewise, we can ascertain profitability into different segments. So after all the profitability ratios, we can calculate ROCE. This measures the overall profitability, and ROA, which measures the return on the assets which we are going to utilize. Then finally, we are going to focus on the market value ratios. Some persons are referring this as the investor ratios as well. Here we are going to measure, do the investors like to reflect in the PE and MP ratios, which means if the investors have an interest, then this PE ratio, which measures the market price divided by EPS, will go up. And in the MB ratio, we are going to divide the market value with the book value. So most of the time, investors are using the PE ratios to evaluate. Why? Because this market value divided by book value is arbitrarily subject to different manipulations in the accounting. Therefore, rather than going for the book value, we are preferring to go for the PE ratio. Then we are moving to the general profitability ratio. So here you can see we can measure the general profitability based on the gross profit ratio. Here gross profit is divided by the sales and multiply into 100. Then operating ratio. Here operating ratio, we are going to divide the operating cost and net sales. We are going to identify whether the net sales are able to cover up the operating cost. Then expenses ratio. So this expenses ratio can be categorized into different segments: administration expense ratio, distribution expense ratio, and we can identify what is the portion when compared to the net sales. And operating profit ratio, by taking the operating revenue and deducting it with the operating cost, we can identify the operating profit, and then we can divide it with the net sales and identify the operating profit ratio. So here, what do you mean by the net sales? So sales is the total selling price into quantity. But if we have the sales return, then to get the net sales, what we are going to do is from the overall sales revenue, we have to deduct the sales returns. Then we can get the net sales. Is it clear, everyone? Okay. Now next one, overall profitability. So this overall profitability is more or less similar to the general profitability. But here we are focusing on the overall industry of the company. Here, first one we are going to measure is the return on shareholders' investment or net worth. This is known as ROI. So in the ROI, what we are going to do is we are going to take net profit after interest and tax, and then we are going to divide it by the shareholders' fund. So please remind, we are going to take the net profit and we are going to divide it with the shareholders' funds only. Then the next one is return on equity. In the return on equity, from the same profit figure, we are going to deduct the preference dividend. Why? Preference dividend is not for the equity holder. Therefore, we are going to deduct that particular figure and we are going to take the net return only for the equity holders. Then we are going to divide it with the equity capital. So normally in Sri Lanka, you know that equity capital is the market value. Therefore, we are just taking the stock market equity value. But if you are going for the other countries, such as in US, you can see there are paid up capital. In that case, we are going to divide it with the paid up equity capital. But according to the Sri Lankan accounting governance rules, CSC rules, since we have the market value, we are just compared with the market value. Is it clear? Now next one, return on net capital employed, which means the ROCE. Here in the ROCE, we are going to take the adjusted net profit. So this adjusted net profit figure can be taken from the operating profit or earning before interest and tax. Right? Then from the earning before interest and tax, we are going to deduct it with the net capital employed. The net capital employed means net current liabilities plus ordinary shares plus all the reserves, whether it can be a capital reserve or a general reserve, plus the preference shares. So here you can see all the values relating to the equity in terms of shares as well as non-current liabilities are figured in the base of the ROCE. Clear? Then I'm going to move into the investor ratio. So in the investor ratio, we are going to see the investor's faith on the particular company. So we can get the EPS ratio. So in the EPS, we are going to take the net profit after tax minus the preference dividend. Then we are going to divide it with the number of equity shares. If the equity number is changing over the period, we have to take the weighted number of equity. Can you remember? Weighted number of equity we have to get in the case of if the equity shares are changing over the period. Then next one is dividend yield ratio. So here we are going to divide the dividend per share with the market value. So here we are focusing what will be getting as the return in terms of dividend if we invest particular amount in this company's shares. Then the next one is dividend payout ratio or payout ratio. So here we are going to see dividend per equity share. So how we are going to take dividend per equity share? First we have to take overall dividend and then we have to divide it with number of shares. Then we are going to compare it with the earning per share. So we can say how much we are going to retain in the industry and how much we are going to distribute to the common equity holders as dividend. Is it clear, everyone? Harida? තේරුණාද ඔය ටික? ඒ තියෙන ජෙනරල් ටික හොඳේ. So the next one I'm going to start. The next one is liquidity ratio. So in the liquidity ratio, what we are going to see current ratio and quick ratio. So I know that you are familiar with this current ratio and quick ratio. In the current ratio, what we are going to see current asset divided by current liability, and in the quick ratio, we are going to see liquid assets. So liquid assets is, we know that when we are hierarchying the current assets in the statement of financial position, how we are going to hierarchy this current assets based on the liquid pool. So liquidity is more in the cash, therefore it's go in the down of the statement. And since the inventory is less liquidity, therefore it comes as the top of the current assets. So here we are going to access the liquid assets. Therefore, from the overall current assets, we are going to exclude the inventory. Then we are going to divide it with the current liabilities. Then I'm moving to the efficiency ratios. So in the efficiency ratios, you can see, so there are several sets. First one, we can take the turnover ratios. It can be inventory turnover ratio, debt turnover ratio, and creditors turnover ratio. Then here we are going to see how efficient we have utilized the inventory, how efficient we have utilized the debtors, and how efficient we have utilized the creditors in the company. To calculate the inventory turnover ratio, what we are going to take is the cost of goods sold divided by average inventory. So here we are going to take average inventory at cost. Then in the debt turnover ratio, what we are going to take is, we are going to take the net credit sales and we are going to divide it with the average trade debtors. So how we are going to take the average? Average is, if we have 2 years, then we are going to add them together and we are going to divide it by 2. But to do this, we have the comparative years. But if we don't have the comparative years, what we are going to do, we are going to just divide it with the trade debtors in that particular year itself, rather than taking the averages. Then what we can take is the creditors turnover ratio. In the creditors turnover ratio, what we are going to do is, we are going to take the net credit purchases and we are going to divide with the average trade creditors. Right? So after taking these turnover ratios, what you can do is to get the collection period. So if you are going to calculate the operating cycle or working capital cycle, you need these period terms. So if we are going to take the debtors, what we are going to do is, we are going to calculate the debtors collection period. Right? How many days or how many months, whether we are going to spend to collect money from the debtors. So to get that, what we are going to do is, from the trade debtors, right, in a particular number of working days, we are going to divide it with the net credit sales. Then to get the average payment, we are going to take net trade creditors and we are going to divide with the net credit purchases, and then we are going to multiply the number of working days. So same as for the working capital turnover ratio. So this number of working days may be subject to different companies. So you know that in the working capital chapter in the finance management, based on the IM pound days recognition, the working capital days are 360. But in a normal company, what we are going to see, the working capital days are 365. But if a particular company just working 5 days, then if in a year we have 52 weeks, what we are going to do, we are going to multiply that particular days with the number of weeks itself, and we are going to calculate the working days. Right? So the next one, right? So in the efficiency ratio, another one is total asset turnover ratio. So here we are going to take the revenue and we are going to divide with the total assets. So we can do this by taking the total revenue and divided by the current assets, right? And current liabilities, as well as we can take the current liabilities, non-current liabilities, and we can add with the capital value as well, which means this base can be changed. Here we are just going to take the total asset. At the same time, we can take the capital plus liability itself. At the same time, we can calculate it by the capital employed. So this asset turnover ratio can be manipulated with different terms. Can you see? Different bases we can use. Then the next one is property, plant and equipment turnover ratio. Here we are going to divide the revenue by the total value of the property, plant and equipment. So here we have to take the net value. How we are going to take the net value? From the cost, we are going to deduct the accumulated depreciation. Then we are going to see the long-term solvency ratios, right? So in the long-term solvency ratios, we can see debt to equity ratio, then debt service or interest coverage ratio. So normally it is known as interest coverage ratio, as well as capital gearing ratio in terms of solvency ratios. So debt to equity ratios is debt divided by equity. Then interest coverage ratio, how we are going to calculate it? From the net profit before interest and tax, we are going to divide the fixed interest charges. Then we can take the capital gearing ratio. How we are going to take the capital gearing ratio? From the equity shares, we are going to divide with the fixed interest bearing funds. In other words, from the equity, we are going to divide the debts in the capital gearing ratio. So then let's see in the next one, what are the problems and limitations of the financial ratio analysis? So we know that, right? In the ratio analysis, even though it gives so many benefits for us, right? Even though it gives so many benefits for us, compare with the industry average is difficult from the firm operating in many different divisions. So just take John Keells. In the John Keells, you know that John Keells have hotels. John Keells have hospitals. John Keells have this supermarket. So how we are going to compare that particular company with the industry averages? So it's difficult to compare, right? We can't have a static figure. So in the different industries, we have different averages. How we are going to compare this consolidated company with this industry average? So it's difficult. Then the next one is average performance, not necessarily good. So even though we can say that average this particular company is good, but it doesn't mean that it is always good. So there may be certain facts which adversely affect the company's performance. So it may not be reflected in the financial analysis. Just we are going to take the ratios in a way of standard forms. Then the next one is seasonal factors can be distorted in the ratios. So you know that in the April season, in the December season, there may be seasonal influences. So these seasonal influences may not be reflected in the ratio, and this is why we are going to take the average figure. Then window dressing. So window dressing is an accounting manipulation technique. So by this manipulation technique, we can boost up the profit as well as we can reduce the cost. So if we are applying these techniques, then the financial statement analysis based on the ratios may not be useful. Then there's another one. Different operating and accounting practices in different companies may distort the comparison. If a company is using FIFO, if the other company is using the LIFO, then this comparison may be difficult. If a particular company is using straight line basis in the depreciation, if another company is using double-digit depreciation, then the comparison may be difficult. Then we will move to the next one. Sometimes it's hard to tell if a ratio is good or bad. So normally we know that in the current ratio, 2:1 is the normalized general standard. In the quick ratio, 1:1 is the normalized general standard. So how we are going to compare the profit? How we are going to say whether it's good or bad? It depends. In certain industries, we can have double digits, which means more than 10% in the profitability. But in certain industries, the profitability will be less than 1 digit. Right? So then it's difficult to compare. Then next one, difficult to tell whether the company is on balance, a strong or weak. So if a company is in a strong way, in a weak way, or in a balanced way, we have to compare with the other companies. So to compare the other companies, we must have similar accounting patterns or practices. So if the similar accounting practices are not there, then it's difficult to compare between the companies and tell whether the company's position. Then next one is, what are the qualitative factors analysts should consider when evaluating a company's likely future financial performance? So we know that ratio analysis is giving the quantitative factors. Ratios are based on the calculations. Therefore, it is give a quantitative factors. But qualitative factors means not the rupees and cents. It is based on the general characteristics. So when we are going to compare company, what we are going to do, we are going to analyze both qualitative factors as well as the quantitative factors. So in this one, we are going to compare right? So here, first we are going to see whether the company's revenue tied to one key customer, which means if the company's revenue is based on a one particular customer, then there is a trend. Why is the trend? If we lose that particular customer, overall company sustainability is a question. And therefore, we know that we have to right? So normally, therefore, what we are going to do, we are going to have a portfolio of customers, which means we can have several key customers, then several medium-time customers, as well as several customers, which is small, but in a large scale. Then next one, to what extent the company's revenue is tied to one key product. If the company's revenue is based on one particular product, if we don't have the supply to manufacture that particular product, then the company's revenue will be in a great risk. So what we are going to do is, in a company, we are going to sell a bulk range of products. Just take the Unilever. In the Unilever product portfolio, what you can see? You can see the baby care products, right? You can see healthcare products. You can see household items, right? You can see medicines in the Unilever package. So there is a full range of products in the Unilever. So they are not relying on a one key product. But if a company in the small scale, so that particular company may be relied on a one key product. Just take a small baker. Sometimes in the bakery, they may just sell fish buns, pastries, or burgers. Sometimes in the bakery, they may sell wedding cakes only. Sometimes wedding cakes in the sense, the cake structures only. Birthday cakes only. Then if they don't have the weddings, what will happen? They don't have the income. So if they don't have the birthdays, what will happen? No income at all. Therefore, in a bakery, what you can see, there is a range of products. Normally, cake manufacturers have wedding cake structures. So, normal wedding cakes in the pieces. Then they have the birthday cakes, anniversary cakes, right? So, Valentine cakes also there nowadays. So many ranges are there in the cake package. Now, when it comes to the other short eats, you can see fish buns, tea buns, burgers, pastries, so many things. Then other than that, they have the beverages also. Orange juice is there, Milo packets are there, Nestle packets are there. Why they are doing that? Even though they are in the small scale, they have to maintain the revenue. So they are going to maintain a portfolio of products, right? In that particular company. Then next one, to what extent does the company rely on a single supplier? So what will happen if you are going to rely on a single supplier? See, in the COVID scenario, what has happened? So China has stopped all the imports itself. All the imports and they are stop their exports. If they stop the export, if the Sri Lankan companies are rely on the Chinese imports, what will happen? They can't do the manufacturing. So they have to stop the manufacturing. But if they are rely on the local suppliers as well, right, then they can maintain certain level of production without hampering their operational process. So there is a risk. That's why we are not going to say, don't rely on a particular customer. Don't rely on a key product. Don't rely on a single supplier, right? Always you have to maintain a portfolio, right? Then next one, what percentage of the company's business is generated overseas? So now you can see in the Sri Lanka, there is a dollar crisis. If in the Sri Lanka, we have a dollar crisis, so if we are generating operations in the overseas, sometimes it may be difficult. It may be difficult to open the LCs, letter of credit, so it may be difficult to open them. Sometimes the companies in the abroad may not have the faith. Therefore, they are so here we are going to check the competition. So if we are going for the South Asian countries, in the South Asian region, most of the companies are going for Bangladesh. Why they are going for Bangladesh? Since the Bangladesh infrastructure facility is high. If the infrastructure facility is high, then they can produce the same product, right, with the lesser cost. Therefore, we have to identify how much they can recover from the operations in the overseas. Then the next one, future prospect. So if we are going to start a company in the Afghanistan, what will happen? If the Afghanistan environment, so we know that it's a turbulent environment with the war and all. So then we can't see the future prospects. But if we situated in India, you can see this Indian economy is booming into the third stage. So China is the major economy. Then America is the second. And thirdly, we can see the booming Indian economy. So if we have future prospects, so we have to ascertain whether we are going for that particular country or not. Then legal and regulatory environment. So if a particular company is going for abroad, they have to see the legal and regulatory environment. So if the companies have strict rules, then it may be difficult to operate in that particular country. So most of the companies are seeking flexible terms, lean terms when it comes to legal and regulatory environment. Then how we are going to improve the return on equity. So return on equity means net profit divided by the equity. So how we can improve the return on equity? One way is we can improve the return. The other one is we can deduct the equity. So first one is we have to use more financial leverages. Financial leverage increase the company's return on equity. So we can take the after-tax cost of debt benefit when it comes to financial leverage. Here, it means we have to go for more debt rather than equity. If you are going for more debt, then equity portion will be go down. Then ROE will be go up. The second one, increase the profit margin. So this profit margin can be increased by increasing the selling price, increasing the selling cost, lowering the cost of goods sold, then reducing the overhead expenses, and so forth. Then we can improve the asset turnover. So asset turnover means we can efficient the asset utilization process. Then we can distribute the idle cash in terms of dividends as well. Finally, we can lower the tax rate. Next one. Right? An upward revaluation effect on the ROCE. So upward revaluation means what? We are going to revalue the company. But this revaluation figure may be up. Right? So now tell me, what is the ROCE? What is ROCE? Operating profit divided by capital employed. Capital employed in the sense non-current liabilities plus all the equities. The equities, right? So how we can see a upward revaluation? So you know that revaluation is affecting for the assets mainly. How we can impact on the ROCE? So in the ROCE, non-current liabilities plus equity is same as the total asset divided by the current liabilities. Same effect will be there. So you have to identify the similarities between the capital employed and the net assets. Clear? So if the net asset base is up, what will happen? The ROCE will get down. Right? So in upward revaluation, what will happen? The ROCE will be adversely affected. So now read it with the theory. Okay. So the next one. Factors caused an increased GP margin. What is the GP margin? Gross profit divided by sales. So how we can increase this? One way is we can increase the gross profit. The other one is we can reduce the sales. So rather than reducing the sales, we are focusing on increasing the gross profit. So first one, we can increase the selling price. Then the second one, we can decrease the cost of sales. Why only cost of sales? Gross profit means we are focusing on the core business operations. Core business operations are in the trading account. Trading account, we are only focusing on the cost of sales. Then we can change the product mix in favor of high margin products. So if the product margin have the high sales margin, then the profit will be higher. So we are going to change the product mix in favor of high margin products. In other way, can you remember the GCB matrix? In the GCB matrix, you have the stars. You have the cash cows. You have the problem childs. You have the question marks. Here we are focusing on the stars. Clear? Then the next one. In computing return on assets, how does the age of the asset influence the interpretation of the values? So how we are going to take the return on assets? Return, net profit after tax divided by the assets, right? So how we can see the age of the asset influence on this particular value? If the age of the asset is high, the net asset value will be get down. Is it clear? Right? So how we can see? If a particular asset depreciate on the one year, and that particular asset after depreciating 5 years, then there will be two set of values. एक අවුරුද්දක් ෂෙයා කරලා තියෙන කොටයි අවුරුදු 5ක් ෂෙයා කරලා තියෙන කොටයි asset වල වටිනාකම් දෙකක්. Right? So now remember that key point, right? Now go through. Old asset will carry on the books at lower depreciated value, which will tend to make return on asset figure appears high, right? This is contrast to the ratios based on newly purchased equipment. So we know that in the newly purchased equipment, net asset value is high. Old asset, net asset value will be low. Clear? Current asset එක මොකද්ද වෙන්නේ? ෂෙයා කරලා වැඩි වෙලා ඒ asset වල වටිනාකම් මොකද්ද වෙලා තියෙන්නේ? අඩුයි. හරිද? එතකොට මොකද්ද වෙන්නේ? asset ගන්න අඩු හින්දා return එක ඒ විදිහටම තියෙනකොට යට කොටසනේ අඩු වෙන්නේ. ROA එක වැඩි වෙනවා. අලුත් asset එකක් ගත්තම net assets වල value එක net book value එක වැඩි. net book value එක වැඩි නම් අර return එක අරප ගාන නම් වැඩි අගයකින් බෙදුවම ලැබෙන ගාන අඩු වෙනවා. Is it clear? Now next one, the analysis may wish to, right, partially discount the appearance of the high rate of return on older assets. An even better approach would be to replacement cost accounting. So there is another thing we can use for this solution is the replacement cost. I'm not going to explain this. This will be covered in the advanced financial analysis areas. Then next one. What ratios are like to be the greatest interest of the bankers or trade creditors or to the bondholders? So you know that there are 5 categories of ratios. What are the 5 categories? Liquidity, profitability, investors, efficiency ratios, solvency ratios. For these 5 categories, what are the ratios interested to the bankers, trade creditors, or bondholders? So they are focusing on the mainly the liquidity ratios and solvency ratios. So the bankers and trade creditors will focusing on the liquidity ratios to determine the firm's current ability to meet the short-term obligations, right? But the bondholders may primarily influence on the debt ratios. They will focusing on the debt to total asset ratio, debt to equity ratio, rather than focusing on the other ratios. So they may see the profitability and in terms of ability cover its interest payment, which means they will focusing on the debt ratios mostly. Bankers and creditors focusing on the liquidity ratios, while they are focusing on the short-term payment ability. But bondholders' bonds will be repaid in longer years. Therefore, they are focusing on the long-term debt or the solvency ratios. Now, next one. Right? If the firm's return on equity is substantially higher than the firm's return on asset, what can the analysis interfere about the firm? So if the ROE is greater than ROA, so what do you mean by ROE? return divided by equity. ROA means return divided by assets, right? So if the ROE is greater than means, right, the firm has the heavy debt commitment. Equity එක වැඩි නම් total asset එකට වඩා debt commitment එක වැඩි. This can be seen by looking at the DuPont analysis. So now in the FM, you are going to do the DuPont analysis. Karane FM එක DuPont analysis. So in the DuPont analysis, you will analyze the relationship between debt, return on assets, and return on equity. The final one, how does the asset utilization ratios relate to the liquidity ratios? So what are the asset utilization ratios? All the turnover ratios. How these turnover ratios are related to the liquidity ratios. So faster turnover ratios on asset create more rapid movement in cash. So if the more rapid movement in cash is there, then there is an improvement in the liquidity. Therefore, these asset utilization ratios and liquidity ratios are interrelated together.